Welcome to The Explainer. We're always told to just pick the fund with the lowest fees. Easy, right? But what if that simple advice is actually, dead wrong? Today, we're digging into S&P 500 ETFs to uncover a hidden cost that could be costing you an absolute fortune.
So let's kick things off with a piece of advice that's practically investing 101, right? We've all heard it a million times. If you want to maximize your returns over the long haul, you've got to pick the fund with the absolute lowest expense ratio. It seems like a no-brainer. But what if that little number you see on the screen isn't the real price you pay? What if that simple, tiny percentage is actually hiding something much, much bigger? Something lurking just below the surface that's way more important than that headline fee.
Okay, get this. We're about to break down an analysis that shows how picking the wrong ETF, even one with a super low fee, could cost a Singaporean investor, wait for it, 72,000 Singapore dollars over 20 years. I mean, that's a huge number. That's not just some small mistake, that's a game changer. So let's dive in and figure out what's going on here.
Okay, so we're going to be looking at 4 of the big players, the most popular S&P 500 ETFs that are out there for us here in Singapore.
All right, here they are, our 4 main contenders. We've got VOO and S27 based in the US, and then CSPX and SPY5 over in Ireland. Now just look at that expense ratio row. Your eyes probably jump right to VOO and SPY5, right? I mean, 0.03%, that's practically free. So, based on the classic advice, these look like the obvious winners.
And that, right there, that is the trap. It's what I call the low-fee illusion. You'd look at that table, pick VOO or SPY5, and pat yourself on the back. But this is exactly where things get interesting, because that fee, it's not even close to the whole story.
Okay, here it is. This is the key. For an investor in Singapore, the biggest thing eating away at your wealth isn't the fee you pay. It's taxes. And over a long time horizon, like 20+ years, this effect gets amplified like crazy. The fee is the little monster you can see. The tax is the giant one hiding in the closet.
So you're probably asking, okay, what is this hidden tax? Well, it all boils down to something called dividend withholding tax. And this is where the fund's domicile, the country where it's officially set up, becomes absolutely critical. So here's how it works, in simple terms. When all those big U.S. companies in the S&P 500 pay out dividends, the U.S. government wants its slice of the pie. It takes a cut of that money before it even leaves the country to get to you, the investor. It's an automatic tax, and you don't even see it happen.
And wow, this slide lays it all out. It's the whole ballgame right here. If you're in a U.S. domiciled ETF like VOO, the U.S. government takes a whopping 30% of your dividends. Gone. But here's the clever part. Thanks to a special tax treaty between the U.S. and Ireland, if you pick an Irish domiciled fund like CSPX, that tax gets chopped in half, just 15%.
Now look at this chart. This really puts it in perspective. For VOO, that tiny little bar on the left, that's its expense ratio, 0.03%. Almost nothing. But look at the bar next to it. That's the hidden tax drag. It's 0.39% every single year. That's, 13 times bigger than the fee? This is the real cost you're paying.
So what does that mean in real dollars? Well, over 20 years, that small tax difference just compounds and compounds. By simply choosing the more tax-smart Irish fund, CSPX, instead of VOO, your portfolio could be SGD 54,000 richer just from that one decision. But hold on, because it gets even wilder.
Yeah, there's another hidden cost. A much bigger one, actually. It's a silent killer for your wealth that most people have never even heard of, and it could seriously impact the money you plan to leave behind.
Okay, this is super important, especially for long-term investors. It's called the U.S. estate tax. If you're not a U.S. citizen and you hold U.S.-based assets, like VOO, and your investment grows beyond $60,000 US, the U.S. government can step in and take a massive slice of it when you pass away. We're talking up to 40%. It's a huge tax on your legacy.
And the difference this makes? It's just mind-blowing. Look at this. With an Irish ETF like CSPX, your family is totally exempt. The tax bill is zero, zilch. But with a US ETF like VOO, on a pretty standard SGD $300,000 portfolio, your heirs could be slapped with a tax bill of over $100,000. That's a life-altering amount of money to lose.
Okay, so now that we've pulled back the curtain and seen these massive hidden costs, the dividend tax and the estate tax, the picture of which ETF is really the best choice, well, it's starting to look a whole lot clearer, isn't it? And it's not just about taxes. CSPX has another awesome feature. It's what's called an accumulating fund. So instead of paying dividends out to you as cash, it just automatically reinvests them right back into the fund for you. It's seamless. This puts your compounding on autopilot and means zero effort for you.
The other funds, on the other hand, are distributing. And this just creates hassle and hurts your performance. They spit out dividends as cash into your account. That cash then just sits there doing nothing, missing out on market gains. We call that cash drag, until you get around to manually reinvesting it. It's just inefficient.
All right, so this is the final showdown. When we add everything up, the fee you can see and the hidden tax drag you can't, the whole story flips on its head. The U.S. funds, VOO and S27, which look so cheap at first glance, actually have the highest total drag. Now, you might notice SPY5 looks like the winner here, but there's a catch. It's still pretty small and doesn't trade much, which can make it kind of risky and difficult to buy and sell for now.
So when you put it all together, the better tax treatment, the no-hassle accumulating structure, and the fact that it's big and easy to trade, CSPX really stands out. It's the optimal long-term choice, and it could mean you end up with tens of thousands of extra dollars in your pocket over 20 years compared to the low-fee options. So here's the final verdict, the bottom line. For the average long-term buy-and-hold Singaporean investor with a decent-sized portfolio, CSPX is the clear number one. It's the smart choice. VOO, it's really for the short-term traders who need that high liquidity above all else. And S27 is a special case. It really only makes sense if you're trying to get tax relief inside your SRS account.
And that brings us to the final big question you should be asking yourself about your own portfolio. Are you just looking at the obvious V, or are you digging deeper to find the total, real cost of your investments? Because as we've just seen, understanding the difference, well, that's where long-term wealth is either built or lost.